Good evening, everyone, and welcome to another session of Option Wednesdays. I'm Prashanth Lalu from Kotak Securities and your host for today. Uh, Today's topic is on derivative terminologies. So, can we have the slides, please? पिछले 3 सेशन में आप लोग फ्यूचर्स एंड ऑप्शंस और प्राइसिंग ऑफ ऑप्शंस के बारे में जानकारी मिला आपको. आज का सेशन होगा डेरिवेटिव टर्मिनोलॉजीज. Today's session is all about open interest, futures build-up, and various other terminologies. What I would call them as derivative tools, so that these tools you can use to enhance your trading. You will learn how to interpret them and how to use them in live market scenarios also. So the first one is open interest. As the name suggests, open is all the contracts that are open in the market, and interest is where basically the maximum money in terms of if you're trading options, where the maximum concentration of commitment of money is there, and also in the futures segment, whether there's an increase in activity or there is a decrease in activity is what you can gauge with open interest. So we all know that volume goes with trend. So in comparison, just like volumes, open interest is all about the commitment level of market participants. What is the kind of money that is coming into a particular contract is what open interest would suggest, and this would enhance the direction of the market and your view of the market, so that you can take a trade on the right side and also minimize your losses if there is a change in any of these tools. So open interest basically is total number of outstanding contracts. Now, how the contracts are calculated, you will come to know in a bit. So, as I said, the high open interest indicates high commitment levels and the bet size, and you could probably gauge which side the market is going, whether it is with the stronger hands or the weaker hands, and also tells the sentiment of the market. So when it comes to open interest, since all the contracts are open contracts, for every buyer, there will always be a seller. So as I told you, for every buyer, there's a seller. So if, for example, in this scenario, buyer A has a seller B. So it does not become two contracts, but it is one. So even though the buyers change, for example, in the third example, if A and D come in and B and C are there, so it's just two contracts, because the simpler way to look at it is how many buyers are there or how many sellers are there individually. So that would probably give you a better understanding that it's, as buyers and sellers come together, it is always calculated as one. And as the number of buyers increase, there has to be equal number of sellers as well. So that's why you straight don't multiply into the buyers and sellers and come to a figure which would be inappropriate to calculate the open interest. So how is open interest used in futures? For example, if you're buying Bank Nifty or Nifty or any of the stock, how do you interpret open interest is what we can know from here. So one is the price. So in general, for example, in a market, if the prices are rising, you tend to think that, okay, the prices are rising, so there must be a buying interest. That is the first thing that comes to your mind. But let's look at what happens when you when you attach an angle of open interest to it. So as you can see here, as the price rises and there is a significant buildup of open interest, along with the price, that is a long buildup. So that means there is more buying interest, commitment of money is there from the people who think the market is going to go higher, and which is also negated by the price movement as well. So an increase in open interest along with an increase in price results in a long buildup. Vis-a-vis, what happens when the longs are being wound up? What if they are squaring off the positions? So what would ideally happen is that the level of commitment would probably come lower, and maybe because there is an event, or maybe the market has reached a saturation point, or if people say that okay, this is the resistance level in the market. So in these circumstances, what the long people who have gone long would start unwinding their positions. And in a similar fashion, if someone is shorting in the market and the price is going down, so basically what happens is, as more and more people build their short positions, the open interest will increase. This, however, has to be matched with the decline in price. So that is what is a short buildup. And again, when the people who have shorted in the market start unwinding their position, so you will see a decrease in the open interest, and probably, the stock or the bank nifty or nifty has come to a level where you can probably think it is a bottom, or there is a possibility of reversal from here. So that's what this short unwind would probably depict. Now, all of this is, you really can't sit and be in front of the screen and see which stock is going up. Along with that, what is the long buildup or the short buildup, or how to gauge all of this. So what we have here on our trading platform with Kotak is, you have this screener, which is like a heat map, where it pretty much shows where there is a long buildup, which is all in green. You have the short buildup, which is all in red, and the other aspect is short covering, or if there is long unwinding, which is in orange. So, instead of, as I said, going into every stock and trying to gauge which side the stock is going, or what is the position in the open OI with respect to the price, this is a very easy tool to use, and you could probably base your trade on this screen, looking at this, just by looking at the screen. For example, if there are a lot of for example, banks on the green, so you could probably say that okay, there is a lot of long buildup in a lot of banking stocks, and you could probably take a long on bank nifty itself, that is if you're a bank nifty trader. So this is how you use this feature which we have. And moving over to rollovers. So what happens with rollovers is, everyone has, let's say, for example, you take, for example, this month of June, you have a certain number of positions in the market. Now, if you are a buyer in the market and you think that the momentum in the stock or the sector is going to carry forward, or even in nifty, what you would ideally do is, you would roll over your position, which means you will square off June contracts and buy into the July contracts. So what it means is that the sentiment of the market continues to be on the positive side. Or if, let's say, a lot of people think that no, July may not be such a good month, so what will happen is, they will just square off the positions in June, and they will not buy into fresh positions of the same long positions which they had in June in July. So that is how you interpret rollovers. So here, rollover is an important data when it comes to the broader sentiment. And this is, as I told you, that a strong rollover would always mean that the same sentiment gets carried over to the next month. Vis-a-vis, if there is a weak rollover, then the same sentiment may not be carried over to the next month by a lot of traders. So what is the kind of rollovers that we usually see on a month-on-month basis? Usually on the Nifty, Bank Nifty, on the major stocks, we usually see about 85% of rollovers, and that is considered a strong rollover into the next month, and we can interpret that the same sentiment is going to carry over into the coming months. So that is all about rollovers. Now, the most important aspect is the option chain. Now, you would have seen option chain in various aspects, and what does the option chain mean and why should you use it? Now, you all have learned in the previous session that what is an option contract? It contains the underlining, the strike, the details of the option, whether it is a call option or a put option, the lot size, obviously, which is predetermined, and the expiry date. Now, we also learned about the Greeks, which is the delta, gamma, theta, vega, and rho, which tells you about the pricing of options and how the mechanism works. Now, in the options chain, what people do is they use this option chain in live markets, and what it shows is basically where the open interest is, where is the concentration, where is the commitment of the money, what is the change in open interest, what are the implieds for different strikes. So this is what you use as a trader when you are trading options in live markets. So let's see how you can use this in live markets. So for example, if you see this is a Nifty contract, and we have the strike prices in the center, which is in blue. And what we have highlighted is where is the major option concentration. So we have selected 16,000 call options and 15,700 put options. So why did we select 16,000 call option? In the market, it is said that the writers who has the highest risk, he is usually right in all his trades. So what we see is, and his commitment of money in the market is much higher, because the margin required for writing of options is much higher than buying of options. So at 16,000, there is a max open interest, which justifies that the writer has most likely written options of 16,000, and the chances that the market would breach this level of 16,000 would be that much lesser. So what happens is there will always be a level like this from the beginning of the month, and it is bound to change depending on the movement of the market. For example, even in this scenario, if you go to see, the max open interest here is actually at 15,500. Okay, but we have selected 15,700 because the expiry is right tomorrow, and so the next highest open interest after 15,500 is at 15,700, which means the writer of the put option here has a maximum commitment of money, and a breach of that would would probably see a sell off, or probably the market would go down to the next level of 15,500. So he's carrying a higher risk. So you could probably say that the range for the market might be 15,700 and 16,000. So the other aspect that you should also keep in mind is what is the change in open interest, whether there's an addition or a subtraction. So when you know that there is an addition in the open interest, that means that okay, there is an increase in commitment levels at probably 16,000 calls. And for example, if there is a decrease in the change in open interest, that means okay, the money is being reduced. There is possibly an unwinding of those positions. So this is something that you'll have to keep in mind when you're trading, and it is important to just not about to keep an eye only on open interest, but also the change in open interest, because it adds just a huge value point at any given for any given trade that you might take after gauging these aspects. So, in the previous example, as I told you, the maximum OI. So this is the OI distribution where there's a graphical representation of where the open interest is, and as you can see, it is actually at the 16,000 call and 15,500 put options. And yes, we have highlighted the 15,700 put options also because the next highest commitment level after 15,500 put is at 15,700 put options. And as I told you, the range for the market may probably be 15,700 and 16,000. So the chart below shows actually a change in open interest and where the maximum change has happened. So this is another feature that you will have on a trading platform. So it is easier for you to take these tools and interpret the market and see which side of the market you want to trade in, whether you want to be a writer or whether you want to be a buyer. So for example, in this trade, if you're doing a strategy, you could probably, since the maximum OI is in 15,500 put and 16,000 call, you could probably write the 16,000 call and the 15,500 put for, and because you already know that this is the broad range that the market might be there for until expiry. So this is how you interpret OI and the change in OI and also the distribution to aid your trading. So the next most important tool that is there is, and a lot of people use, is the put call ratio. So what exactly is the put call ratio? The put call ratio is nothing in mathematical terms. It's nothing more than the number of puts in the market divided by the number of calls. So this can be interpreted in two aspects. One is you could use the open interest or the volume of put call ratio, puts and calls, and arrive at the arrive at the ratio. So how do you interpret put call ratio? Usually, most people, what they would do is they would concentrate on these scenarios where there are put buyers and where there are call buyers. So, which means that you are only concentrating on whether there are put buyers, which probably indicates that there are the market might go down from here, or if you're concentrating on call buyers, that which would mean that you are interpreting that the market might move rise from here. But what about the other scenarios? What about the put writers and the call writers who take much higher risk? They ideally should know which side the market would move in the short term, and it is always advised to see what they are doing in the market. Okay, because they usually come up with a higher risk. They are at higher risk because they are the sellers or the writers of the option. So the other important aspect is that usually when you see a put call ratio, you only compare it with open interest. But what you also have to keep in mind is the implied volatility also plays an important role. And that would actually change the dynamics of how you see put call ratio. So this table here is pretty important for you to know when the writers are adding, the put writers are adding, or when the call writers are adding positions, or when they are unwinding it. And based on this tool, you can always gauge again whether there is a stronghold by the bears in the market or the bulls in the market. Usually the put call ratio is between 0.7 and 1.3. So this is the usual range of the put call ratio, and anything beyond this range would mean that there is an event or there's something which might come up in the near term. Okay, so that is the basic interpretation of put call ratio, and that would sum up most of these tools that you learned. But keep in mind that based on just the put call ratio or just the open interest, you cannot base a trade. You use all these tools from the OI buildup to use the option chain to where the option concentration is, and see where the change in open interest is, and use all these aspects to come to a conclusion as before you place a trade. And that's more important. And this would also help you unwind your positions if you're long and see that, okay, if the market is stagnant or if there is a reversal sign on top. These tools will help you indicate, they will help you uh, trade better, and they will also give you an indication. So let's see what questions we have. So someone has asked, what is the range for put call? I've mentioned it is between, the usual range for put call is between 0.7 and 1.2, and this is the range. How do you just hold on. How do you see open interest change? Open interest change, I've already showed you that on our platform we do have that change and the graph. So if you don't want to see the open interest option chain, it is best to use the graphs, and that would be an easier interpretation for you guys. So yeah, that's about the questions. Yeah, I hope you got a view about all these tools that you can use to enhance your trade, and I hope you enjoyed the session.